The $87 million signature, how a legal loophole exposed Wall Street. In the United States of America, mostly financial crimes don't begin with guns, masks, wars, or secret meetings. They begin with paperwork. In 2016, a junior compliance lawyer working in New York signed a document worth less than $10,000. That single signature would eventually uncover $87 million in illegal transactions, expose a powerful Wall Street executive, trigger a federal investigation, and reveal a loophole buried deep inside American banking law. What makes this story disturbing is not just the money. It's the fact that the person who signed the document didn't believe he had done anything wrong. This is the true-to-life story of how modern financial crime works in America, and how the legal system decides who pays the price. Ethan Cole was invisible. That's not an insult, it was his job. At 29 years old, Ethan worked as a compliance associate at North Atlantic Trust, a mid-sized bank headquartered in Manhattan. He wasn't a trader. He wasn't an executive. He never appeared in meetings that mattered. His job was simple, repetitive, and quiet. He reviewed transaction alerts. He verified internal approvals. He signed compliance documents. Ethan earned $82,000 a year, lived in a one-bedroom apartment in Brooklyn, and was still paying off law school loans from NYU. He believed deeply in rules. Rules were predictable, rules were safe, rules meant protection. And in U.S. corporate culture, Ethan believed one thing above all. If you follow the law, nothing bad can happen with you. On a Tuesday morning, Ethan received an automated compliance alert. Transaction amount, $9,800. Sender, Silver Ridge Consulting, LLC. Destination, offshore holding account, Cayman Islands. Under U.S. banking regulations, transactions above $10,000 automatically trigger a currency transaction report. But this transaction was under the threshold, technically nothing illegal. Except it wasn't a loan. Ethan dug deeper. There were hundreds of transactions, all just below $10,000. $9,500, $9,700, $9,800. Month after month, year after year. Total value, $87 million. This pattern had a name. Structuring. And under federal law, structuring is illegal when it's done intentionally to avoid. Reporting requirements. Ethan felt something shift. This wasn't routine anymore. Ethan escalated the issue to his supervisor, Martin Holloway. Martin was respected, 20 years in compliance. A man who had survived audits, investigations, and financial crises. Martin reviewed the data calmly. Then he smiled. "Relax," he said, "it's clean." Ethan was confused. Martin explained the part of financial law most people never learn. Structuring is only illegal if you can prove intent. And intent is difficult to prove when the client is a consulting firm with international operations, legal documentation, and tax filings. Then Martin slid a document across the desk. An internal risk clearance authorization. "Legal already reviewed it," Martin said. "Just sign." Ethan hesitated. But refusing could stall operations. Refusing could raise internal conflict. Refusing could cost him his job. So Ethan signed. That signature would later be described in federal court as material participation in a criminal conspiracy. Life continued. Ethan was promoted. The transactions continued. No alarms sounded. Inside North Atlantic Trust, the system worked exactly as designed. Money moved quietly. Reports stayed clean. Regulators saw nothing unusual. This is how modern financial crime survives. Not through chaos, but through routine. In the morning of one day at exactly 6:17, Ethan Cole woke up to a sound he would later describe as unreal. Not loud, not violent, just final. A heavy knock. Then a voice. "Federal agents, open the door." In that moment, Ethan's mind did not jump to guilt. It jumped to confusion. He had never stolen money, never accepted a bribe, never moved funds. When the door opened, 6 agents stepped inside his apartment. Calm, professional, prepared. They already knew everything they wanted to know. His laptop was seized, his phone was bagged. His hard drives were labeled as evidence. Ethan was placed in handcuffs in the hallway of the building where he had lived for 4 years. Neighbors watched silently. This is how white-collar cases begin. Not with drama, with quiet certainty. At the federal holding facility, Ethan learned something most Americans never do. In financial crime cases, intent is optional. The prosecution doesn't need to prove that you wanted the crime to happen. Only that you understood the risk. You had authority, and you chose not to stop it. This is called willful blindness. Ethan's signature was enough. The government's position was simple. A trained lawyer saw suspicious transactions. A trained lawyer approved them anyway. Therefore, the lawyer participated. North Atlantic Trust cut all contact with Ethan within 24 hours. His email access was revoked. His ID badge was deactivated. His name was removed from internal systems. He no longer existed. North Atlantic Trust hired one of the most powerful legal teams in the country. Their defense strategy was predictable. This was not a systemic failure. This was not executive misconduct. This was a single employee who exercised poor judgment. In American corporate law, this strategy has a name: isolation of liability. You find the lowest-ranking person with a signature, and you build the case around them. The bank cooperated fully. They handed over documents. They hosted auditors. They issued compliance reforms. But no executive was named. No board member resigned. And Jonathan Pierce, the man who designed the transaction structure, remained silent. Investigations continued. Federal investigators followed the $87 million. What they found was not dramatic. It was methodical. The money originated overseas from politically connected real estate developers, government contractors, and state-linked entities. It entered the U.S. financial system legally, passed through multiple domestic accounts, then exited appearing clean. This is how laundering works in modern America. Not by hiding money, but by normalizing it. Every step complied with the letter of the law. Every step avoided the threshold. Every step was documented. Someone had designed it that way. The man, Jonathan Pierce, was not careless. He never emailed directly about crimes. He never signed approvals. He spoke in abstractions. Manage risk internally. Maintain reporting efficiency. This language is common in corporate America. It sounds professional, it sounds harmless. But in court, language reveals intent. And prosecutors were missing one thing: proof. Through it all, Ethan remained the defendant. Because the system prefers clarity. One signature is clearer than a culture. One defendant is easier than a corporation. The prosecution offered Ethan a deal: 5 years in federal prison. No trial. No appeal. Just closure. Ethan refused. Not because he was brave, but because accepting the deal meant accepting guilt. And once guilt is accepted in federal court, it never disappears. During discovery phase, Ethan's attorney requested internal communications. Thousands of emails, most were useless. Then one message appeared, 3 days before the authorization was signed. From Jonathan Pierce to Martin Holloway. Ensure transaction values remain below mandatory reporting thresholds. Compliance approvals should not create external exposure. Risk will be absorbed internally. This was not a suggestion. This was instruction. And instruction establishes intent. When the email was introduced, the courtroom changed. Jurors leaned forward. The prosecution paused. For the first time, the narrative cracked. Ethan testified. not emotionally. Precisely. He explained how compliance departments function, how junior staff absorb pressure, how executives remain legally insulated. Halfway through the trial, federal agents arrested Jonathan Pierce. Inside the courthouse, in front of cameras, North Atlantic Trust's stock collapsed within hours. When the jury foreman stood and read the verdict, the courtroom did not erupt. There was no applause, no visible emotion, just silence. Ethan Cole was found not guilty on all counts. Jonathan Pierce was found guilty of conspiracy, money laundering, and obstruction of justice. For the media, the story was over. A powerful executive had fallen. A junior employee had been cleared. A bank had paid a massive fine. Justice, it seemed, had worked. But verdicts do not end lives the way headlines suggest. They only change the direction of damage. 3 months after the trial, Ethan received a settlement offer. $3.2 million. The agreement was clear. No admission of wrongdoing. No future claims. No public statements beyond prepared language. This is how American institutions close chapters. Not with apologies. With checks. Ethan signed. He understood the reality. Fighting further meant years of appeals, legal costs, and uncertainty. The money was not a reward, it was a transaction. With his record cleared, Ethan applied for new roles. Compliance positions, legal advisory roles, risk management jobs. He received polite responses. Then silence. In finance, there is no official blacklist. There doesn't need to be. Hiring managers don't ask, was he convicted? They ask, is his name familiar? And Ethan's name was. Associated with scandal. Associated with exposure. In a system. Obsessed with risk avoidance, that was enough. North Atlantic Trust survived. The $1.4 billion fine damaged its reputation, but not its existence. A few executives resigned. New compliance policies were announced. Training sessions were rolled out. On paper, accountability had been achieved. In reality, the structure that allowed the crime remained untouched. The loophole still existed. Transaction thresholds still mattered more than intent. Responsibility was still divided just enough to avoid clear blame. Jonathan Pierce went to prison for 12 years. The court called it justice. But Pierce was not the system, he was a product of it. Removing one executive did not change the incentives that reward silence, complexity, and plausible deniability. This is how modern financial crime works. Not through obvious theft, but through process. Through approvals that feel routine. Through signatures that seem harmless in isolation. Compliance departments document risk, but they rarely stop revenue. When compliance conflicts with profit, profit usually wins quietly, professionally, and legally. Ethan Cole never returned to banking. His record was clean, but his name carried risk. In finance, reputation matters more than verdicts. Today, he works outside the system, advising organizations on ethics and governance. He learned the lesson most people never do. Rules do not protect you. Documentation does not protect you. Only power does. In America, the most dangerous financial crimes are not committed by breaking the law. They are committed by mastering it, by knowing where responsibility ends, by knowing whose signature matters, and by knowing who will be left standing when the system needs someone to blame. Ethan Cole followed the rules. Jonathan Pierce followed the system. And the system continues quiet, legal, and profitable. Because in modern finance, the most powerful weapon is not money. It is plausible deniability.